Hi, hello and welcome. My name is Ali Kazmi. I'm delighted to welcome you to our latest edition of AEoI Conversations, and we're glad to have my colleague Chris Orchard with us today. So with that, Chris, we've heard a lot about the OECD's new proposals, and specifically, whilst there's obviously a wider CAF discussions going on, but there are quite profound and important changes to the CRS. Could you perhaps outline them for us?
Yes, certainly, my pleasure, Ali. The CRS obviously has been running now for a number of years, and the OECD has been taking the opportunity to talk to the tax administrations and also through bodies talking to the financial institutions to find out what issues are arising and where improvements can be made. And as part of the public consultation document on the CAF, there is a second aspect to that, which is the CRS. Where is it going? What improvements need to be made? And there are a significant number of proposals that have been put out by the OECD for consultation to see how these can be adapted and adopted to make the whole thing run more smoothly. And it's not just looking at it from the tax administration perspective either. It's looking to see how financial institutions can be helped to improve their systems and ease their reporting burdens. So I suppose that the key things, there are two key areas, I think, which they've raised. The first thing that they've looked at is how they can bring new digital financial products within scope. And there are a number of credible alternative assets out there to money and financial assets as defined, which are currently subject to CRS reporting. And there are a couple of areas which have been expanded into. E-money products is one. These were originally excluded from the CRS because they weren't regarded as being somewhere that could be used in any tangible way to evade taxation. But I think over time, these have become more pronounced and more complex, and therefore larger sums of money can be used in them. So they're being looked at to be brought into scope. And the other thing they're looking at are central bank digital currencies. This is a newish area. Again, it's an area where it's felt that there's scope for people putting their money and their assets into these and can use this to avoid reporting. So consequently, they are being included in. There's a bit of a knockover effect with the CARF, the CAF, in looking at how certain derivatives linked to these crypto assets can be brought into account as well. So that's kind of the new area that they're looking at. But they're also doing a fundamental review of how the CRS is working in its own way. And consequently, particularly around things like due diligence and reporting, there are quite a number of proposals which are being put forward to improve those systems. First and foremost, and I think probably most importantly, there's a proposal to expand the reporting requirements in respect of account holders, in particular identifying the controlling persons in a better way and identifying the financial account that they actually own. So in terms of an entity account, for example, if you've got a passive non-financial entity where you're reporting the controlling persons, there'll be an additional reporting requirement coming in. You will actually have to identify the role of that person. So is that person a controlling person because they own the entity? They'd have a controlling interest in the entity? Are they a beneficiary of a trust? And it will also identify those of the managerial role in the entity. So the senior management team, the trustees, and so on. The whole purpose behind that is to give more clarity around the role of the person so that they can identify more closely those persons of interest. Because in reality, it's the controlling persons who actually have their hands on the money that the CRS is trying to identify. There will be a differentiation requirement in terms of the due diligence processes. So going forward, at the moment, you just report somebody. You've identified somebody's reportable, so we report them. Now you'll have to say, well, how did you report them? Was it because you've got a self-certification because it was a new account? Or did you identify this person through the pre-existing due diligence rules? That again, in turn, gives the receiving jurisdiction the opportunity to look at the quality of the data they're receiving. They would expect something with a self-certification to be a much higher quality data set than those which have just gone through the due diligence processes based on an electronic search, for example. That is quite a major change which is being proposed. One or two more minor ones, such as identifying where an account is a joint account, identifying the type of account that's being reported. So tick a box, is it a depository account? Is it a custodial account? Are you reporting a controlling person of an investment entity, for example? So it's those sorts of things which are being looked at in terms of expanding the reporting requirements. There will be a tweak to the definition of depository institutions as well. Currently, you are a bank, effectively, to be a depository institution, but they've identified certain types of business which are licensed to carry out banking activities, but don't do so, but still have potentially reportable items which jurisdictions will want to know about. So the proposal is an expansion of depository institution definition to include those who are licensed as banks, but who don't currently carry out banking activities. There is going to be a clarification around what is meant by the customer of an investment entity, because that is not as clear as it could be. So hopefully that will make it clearer what should and shouldn't be reported there. And there will be an expansion for the reporting on dual and multi-resident individuals. At the moment, if you apply a tax treaty tiebreaker to somebody's residence, then you just report on the tiebreaker residence. I think that's going to go. If you've got somebody who's dual resident or multi-resident, you'll report all the residences, irrespective of the tiebreaker rules. So there'll be an expansion of the reporting required there. Now, as with all these things, the devil, of course, is in the detail. Anybody who is impacted by the CRS and has an interest in this, I really do recommend you download the document. It's about 60 pages long. There is a lot of detail in there. But if you're like to be impacted on this, it gives you the opportunity to have your say. It is a public consultation. You've got to the 29th of April this year to put your depositions into the OECD. But if you don't do that, then don't be surprised if you get hit by something which you really wouldn't rather have, if you can see that there's a better way of doing it. So that would be my recommendation. Have a look and follow the consultation rules.
Excellent. Thank you very much, Chris. As ever, really insightful. And as Chris said, it's very important to have a say in the consultation process. And we're working with financial institutions to help them articulate their position. So do get in touch with Chris, Emmett, and myself. Thank you very much.